In 2021, someone broke the law to tell you the truth. A source inside the United States government handed thousands of pages of private tax returns to a journalist. Not hacked, not fabricated, real documents, real names, real numbers. What those pages revealed wasn't just shocking, it was completely, perfectly legal. But to understand how this happened, we need to go back to how wealth actually works. Because there are two tax codes in America, one for people who earn money, one for people who own things. You were probably only taught about the first one.
In 2021, ProPublica obtained the tax records of the 25 wealthiest Americans over more than 15 years. The names were familiar: Elon Musk, Jeff Bezos, Warren Buffett, Michael Bloomberg.
Combined, these men grew their wealth by $401 billion over that period. Their total federal income tax bill, $13.6 billion. That is a true tax rate of 3.4%. That is a true tax rate of 3.4%. In some years, Elon Musk paid zero. Jeff Bezos paid zero. Warren Buffett, worth $100 billion, paid a lower tax rate than his own secretary.
This wasn't corruption. There were no offshore accounts here, no shady deals. The secret lives in one word most people have never been taught.
When you earn a salary, the government taxes it the moment you receive it. When a billionaire's stock goes from $1 billion to $50 billion, nothing is taxed. Not until they sell.
Not until they sell.
And billionaires have found a way to never sell.
And billionaires have found a way to never sell. Here is the strategy. It is called buy, borrow, die.
Step 1, buy assets. Stocks, real estate, businesses, let them grow. Step 2, instead of selling and paying tax, borrow against those assets. Banks will loan you hundreds of millions using your stock portfolio as collateral. The loan is not income. Loans are never taxed. You spend the borrowed money, you live, you build more wealth. You spend the borrowed money, you live, you build more wealth. Step 3, you die. When you die, your assets transfer to your heirs at their current value. The original gains, the ones that were never taxed, disappear forever. It is called a stepped-up basis. It is called a stepped-up basis. It is written into the tax code. Your heirs inherit the wealth. The tax bill vanishes, legally, permanently. This is how dynasties are built.
This is how dynasties are built.
Here is what the headlines always miss. Most of these strategies are not just for billionaires. There is a tax bracket most Americans don't know exists. If your taxable income is under $47,025 as a single filer, the federal government charges you 0% on long-term investment gains. Zero. Nothing. Legal. That is not a loophole. That is the actual published tax code. That is not a loophole. That is the actual published tax code.
Here is how regular people use this.
Step 1. Invest in assets that grow, not income that gets taxed. Salary gets taxed at ordinary income rates, up to 37%.
Salary gets taxed at ordinary income rates, up to 37%. But index funds and ETFs held over 1 year are taxed at capital gains rates.
That gap can be worth tens of thousands of dollars over a lifetime. Step 2. Manage your taxable income intentionally. Contribute to a 401k or traditional IRA.
Contribute to a 401k or traditional IRA to reduce your reported income.
The lower your taxable income, the closer you get to that 0% capital gains bracket. A couple filing jointly can earn up to $94,050.
A couple filing jointly can earn up to $94,050 and still pay zero on investments.
Step 3. Hold. Don't sell unless necessary. Every time you sell under 1 year, you pay ordinary income tax. Every time you sell an investment under 1 year, you pay ordinary income tax. Hold it past 1 year, you drop to capital gains rates. Hold it for decades, you start using the billionaire playbook. Legally, hold it for decades, you start using the billionaire playbook. Legally. A 30-year-old invests $500 a month into a low-cost index fund. By 55, assuming 8% average annual returns, that portfolio reaches approximately $570,000. By 55, assuming 8% average annual returns, that portfolio reaches approximately $570,000. If they kept their taxable income under the 0% threshold, their gains could be no attorneys, no schemes. No offshore accounts, no attorneys, no schemes.
Just knowing the rule existed.
Mistake 1. Selling investments too early. Dropping from 0% to 22% over 1 year is an avoidable disaster.
Mistake 2. Ignoring your taxable income. The 0% bracket is useless if a salary pushes you out of it. Mistake 3. Leaving money in a regular brokerage when a Roth IRA grows completely tax-free, including withdrawals.
The ultra-rich didn't build generational wealth by earning more. They built it by keeping more.
The IRS files didn't reveal a crime. They revealed a system. A system written into law. A system written into law. Available to anyone willing to learn the rules. Available to anyone willing to learn the rules. The difference between the people who use it and the people who don't is knowing it exists.
Subscribe to Wealth Mysteries. A new secret drops every week.